Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Brian Overby, Senior Options Strategist at Ally Invest and author of the Options Playbook, to discuss trends in the Nasdaq-100 Volatility Index, or VOLQ, and a potential strategy to consider. Brian, it's great to see you again. Welcome to Trade Talks.
Well, it's great to be here.
Let's put down some background here. How is VOLQ different than the VIX?
Well, one of the biggest things is the index that it's tracking. It's the Nasdaq, the NDX, and at our firm, a lot of our clients, and specifically in the option volume, we see the FANG stocks, the Facebook, the technology stocks are really the leaders each day in volume. And so the VOLQ, the fact that it actually tracks that index, really represents our clients' portfolios a little closer than things like the VIX index, the Chicago Volatility Indexes, and the other index products out there.
Now, the Nasdaq-100 will be rebalanced this Friday. Will that impact VOLQ in any way?
Yeah, a little bit. There's always been debate about that on the rebalancing and what it exactly does to specifically the indexes overall, and it's going to affect that a little bit more. But as far as the volatility is concerned, a lot of times that volatility won't adjust that much. You'll be using some different options from some different underlyings, but I still anticipate that the VOLQ will be trading right about where it is right now, where I see it's right around 24.66 right now in the marketplace.
Right, which is still a little bit elevated relative to historical performance.
Yes, it is, and that's important because there's really no reason for it. We're setting all new highs in the Nasdaq, in the SPX, and all the other indexes, but the VOLQ is just stubbornly staying close to that 25% level. It'd be really nice to actually see it come down to about the 20% level, and that's one little indicator that I'd be looking at. If we could break down below that level, it just shows that there's a little bit less uncertainty in the marketplace, and people would be more believing in the move that we are seeing the new highs overall.
All right, Brian, let's think about a strategy to trade this as we're waiting for vol to come in a bit. And of course, from the Options Playbook, so we can get a sneak peek at your site here as well. What are you going to be looking at?
Well, if I'm looking at things where we have high volatility, a lot of times I like to look at the actual NASDAQ. Now, the NASDAQ right now is up about 1%. It's a 12,000 point index. So because of that, it's a fairly expensive, means the option contracts are going to be expensive. You have an expensive underlying, you're going to have an expensive option contract. You also have elevated volatility. Because of that, I like to look at butterflies in these scenarios. In shorter term plays where you're actually selling two option contracts and then you're buying the wings, you're buying the outside for protection, if you will. When you're doing that on highly volatile marketplaces, those butterflies become very cheap relative to what they were in low volatile environments. And ideally, as expiration approaches, that volatility has to go away. So if you're correct on your forecast, you can get it on for a cheaper, lower price, and it still has all the upside at the end at that expiration date, because that volatility premium has to go away. I don't care if it's a $100 underlying or a $12,000 underlying. At expiration, if there's no time value, it has to go away.
And Brian, if we could do a quick screen share here and get a graphical representation of the strategy that you're speaking about and walk us through that a little bit more in detail, that would be great for viewers to take a look at.
That sounds wonderful. Let's do it. Okay, so now obviously you just have to pick a direction, but overall what I'm showing you right now is actually my book, the Options Playbook, sponsored by Ally Invest, but this is the website that goes along with it. And we have all these strategies basically on a couple of pages inside the Options Playbook and also on the website. And this explains what a long butterfly call would, or a long butterfly spread would be. We'd be looking at using calls if we were bullish to the upside, and then also right here if you were looking at puts to the downside. Now, what I just mentioned earlier is that you're selling two option contracts at the middle strike. It would be strike B here in the long butterfly spread with puts, and that means I'd be targeting a downside movement, and as that underlying stock, if it starts to go down towards that strike, in this case it would be the NASDAQ, that time premium has to go away as expiration approaches. And you can see here just from looking at the profit and loss graph, you're putting it on for a small net debit, but you have good upside potential. This is part of the reason why I like butterflies in expensive indexes around high volatile environments.
All right, Brian, appreciate the insight. Great to catch up with you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.